Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors with the Moose, John Mousseau. It's October 17th, just before the close. Couple of notes, Moose. Last week we went out on a fairly weak Friday. Some volatility this week, intraday and day to day, yet the equity indices, S&P probably up 1.5%, NASDAQ up 2% since last Friday, so some recovery. What I noticed this week, and we try to pick out something that we notice each week, was that weakness in banks. And banks are always a linchpin to broad market activity. It really started off, by the way, off some really solid big bank numbers. JP Morgan,
for sure.
Citi, Wells Fargo. Multiple revenue streams.
Hitting on all cylinders.
Hitting on all cylinders. There was some commentary by Jamie Dimon about some bad debt within a write-off JP Morgan did, and some different debt that some of the regional banks held that has to be written down. And Jamie Dimon had said, there's rarely one cockroach, right? That's an old line, but it got people's attention. So midweek, we saw quite a bit of pressure on banks, specifically regional banks. And why is that? Big banks, JP Morgan, Citi, Wells Fargo, those types of banks have multiple revenue streams. They make money on interest rate spread. They make money from their private wealth departments.
Or trading.
They make money from trading. They make money from investment banking. Lending isn't their holy grail day to day on their balance sheet. Regional banks, different story.
Correct.
They're very lending centric, not just mortgages to individuals, but on the corporate side. So the fear is, going forward, that some of the lending got aggressive in the private space, where they may have lines out, credit lines out to private funds, private credit funds that have then employed that capital in questionable deals. We don't know the answer to that. You know from conversations we've had on these videos that I pay an awful lot of attention to banks, and that was a tip in July of 2007 to start to pull back on the reins. Does a couple of bad private credit deals get me overly concerned? No. But I will pay more attention to some of these quarterly reports. In the meantime, I'm just going to continue to go by some of the math that's been very, very helpful. I'm going to bring up a quick chart. This is a weekly momentum chart for big banks, not regional banks, big banks, the ones we mentioned. I'm not going to get into, as I rarely do, all the details of this chart. But what I do want to point out is that column of O's on the far right-hand side has moved down to about 14. What does that mean? That means 14% of the banks in this particular basket are trading with positive weekly momentum. In other words, 86% aren't. 86% have negative momentum. Historically, I get very interested in either initiating a position or adding to a position, John, when a sector gets to 10 or below.
Right.
And if we look to the left, you can see that when we get that kind of extreme negative momentum, it's a better buy than a sell on the reversal.
Right. A lot of the bad news investing-wise is behind you.
And you've gotten an awful lot of fear baked into price. Now, I also like to do that where a sector that has previously traded with good relative strength is showing some just intermediate weakness. So we'll see if we add to banks, is my long version of what I was showing you with that chart. Moose, I know you want to follow up on some of the bank activity.
Yeah, sure. One of the things this week you saw were yields down, but not a lot. The 10-year bond was a 403. It went to a 4, but it did crack 4.
Hey.
Went all the way to a 395, maybe 393 overnight. What was it concerned about? Exactly what you just said. Are there cracks appearing? Recovered today, closed around 4. 30-year Treasury bond down from a 460 to a 460, kind of the same action. Munis, very good action. AAA 10-year down 10. We've had where are we at 267, 276, excuse me. And more importantly, ongoing money coming into bond funds, muni bond funds, like 700 million. That makes like 9 out of 10 weeks that we have had inflows into bond funds. It's good. What I was going to mention here, though, with regarding the banks, is that what you also heard, you heard Jay Powell speak at the National Association of Business Economists this week. And he basically said, hey, we're concerned a little bit about the fragility of the labor market. We're not as concerned about the inflation that might be coming out of tariffs, and basically gave the market pretty good surety that they're going to get a cut at the next Fed meeting. And as we know, if you get the Fed cut at the next meeting, you get a steeper yield curve. That helps the banks.
Sure. So it's something to keep an eye on. We try to bring something up that we notice each week. We'll keep that in front of you. We'll keep that in front of us as portfolio managers. You'll notice clients within your allocation, whether we're bullish or getting a little bearish on banks. They've been a great trade. The capital markets have been a great trade. The large broker dealers this year.
They've been good. And we've been in a good period for the last couple of months in bonds with yields on a trend being down, and particularly munis who have recovered from what was a rough spring and summer up through the end of July. And probably a pretty good quarter ahead of us because we have big reinvestment periods in December and early January ahead. And boy, the deals this week were well spoken for.
Big demand showing up. Thanks for joining us. We always appreciate it. We'll see you next Friday.